Welcome everyone back and forth with Becker and Orr. You can see Kevin and I are ready to go. We're talking lots of different topics and see them at the bottom of the screen there, including the leadoff topic, the yield curve inversion. First off, what is it and why are people so worried it could be an indicator of a recession? We're going to get into that and much more. You want to stick around.
Yes, as usual, Back and Forth is bringing you the hottest topics of the day and things that you really need to know about in a short period of time. So again, if you want to find out more of our Back and Forth or our Financial 15 videos, please go to our YouTube channel and subscribe. Lots of great content there and lots of interesting things at the moment on this day in time. The other point is you can go to our Facebook and like us there, or by all means, go to our website, beckerorr.com. There's this content, there's great blogs and everything else. Please join us whenever you can. But today on Back and Forth, we are going to start with, as Clint said, inversion. Do we see recession coming? Do we see an expansion going on? What is inversion? Let's start.
Yeah, we're at a complicated topic. We're talking about different bond yields. A good way to think about it, I always think, is if people refer to, say, GICs, right? That's not exactly how it works, but it gives you a good idea, right? You have a link, and then you have a rate of return associated with that. So you might have a 3-year, a 5-year. Same concept with bonds. You have a 3-month, a 1-year, or 2-year, all the way up to a 30-year. And the inversion is when the yield on the 2-year gets higher than the yield on the 10-year. That's how most people view it. That's the indicating the bond traders think there's trouble on the horizon. We could be going into an economic recession. I'll pull up a chart here. This one has a couple of spreads on it. You can see the light blue line at the bottom there. That's the 2s and the 10s. So the 2-year, or pardon me, the 10-year minus the 2-year. Yeah. And you can see it's getting towards negative territory there. And then on the top, you have the 3-month. So even shorter time period, and the 10-year, and they normally go in sync, and then just recently they diverged. So that's an item to talk about as well. But we'll start with the 2-year and the 10-year, Kevin. Normally you see an inversion and then you see a recession. What are your thoughts there?
Yeah, I mean, we've had that for a lot of times. And history, though history does not always repeat itself, it is a good guide for what goes on. Every time almost that we've ever seen a 2- and 10-year inversion, we have seen a recession coming down the road. Now, the one thing that it does not dictate to us, though, is what is the time frame for that recession? Is it 3 months down the road? Is it 6 months? We could be at this point next year and still not in recession, but it could be coming down that time frame. Whether that fits in with the full bull market to bear market run is hard to say. But yeah, usually this is an indication that we are going to see some form of recession coming down the line. And it's usually a pretty good indicator. But again, it's also a forecasting one as opposed to one of those ones that lags like we've seen in a lot of other places.
Yeah, it's a great indicator, except it doesn't give us the timing or severity, which just tend to be important elements if you're thinking about economic recession. Yeah. Is it going to be in a year, 2 years, 4 years? The average is about 2 years. 18 months to 2 years is when you see the inversion to when the economic recession happens. And also, we don't know, is it a mild recession, a large recession? So it's really more questions than it is answers. And it's definitely not good for investors in terms of timing. Like, I would not even have this as a factor if you're going to be investing. No. Because the timing is so all over the map. It really is not that helpful for investors in terms of how to make their investment decisions. But for the bond market, it does tell us a little bit about what bond markets are thinking, that rates are going to be rising, and that they think the central banks specific to the U.S. here are going to be probably raising rates faster than what the economy can handle. That's really what they're telling us, is that rates are probably going to be going up pretty fast, and they think it'll be a little higher than what the economy can handle, and you end up with an economic recession in the U.S. And that's really the difference between the two curves here. The 2-year and the 10-year. The 2-year is what the bond market thinks will happen. The 3-month is what the Federal Reserve has a lot of control over in terms of the central bank. So the central bank hasn't actually raised rates that high yet. So the 3-month is still pretty low. And the bond market thinks they're going to raise rates pretty high. That's why the 10-year has already jumped. Anything you want to add to that, Kevin?
Yeah, and again, I mean, another factor we haven't seen, I mean, this is the most inflation we've had in over 30 years. So, I mean, again, we're getting that interest rate hike. And of course, everybody's anticipating, well, I don't want to go longer term, not if they're going to hike a half point now and, a half point 3 months from now and another half point then. Why do I want to go to the 10-year bond if I can get something short term for a year or two and then I'm going to get higher rates down the road? So again, I mean, there's that play on it and the fact that we haven't seen that inflation for a while. So again, those are all factors to consider. And you can't just look at it and say, oh, the 2 and 10 years inverted, we're having recession. This is not known. So again, we have to take it with a grain of salt and analyze everything in between. But I think that's the biggest factor for the inversion scenario. And now it's time to move on. Let's talk about the Blue Jays. Baseball season is opening soon, and there's a full 162 slate. What are we talking about Canada's only team?
Yeah, we've got some decent odds. I mean, early part of the season, but it's always fun to speculate. Always fun to see
Yep.
how teams are going to fare at the beginning of the season. And this is from the lines. You have a whole bunch of different sports betting things at the top here, and they have the odds. And you can see Dodgers right at the top, and then Jays. Look at that, Kevin. Jays at number 2, and these are the odds of winning the World Series. So
All
Jays
right.
are right there. Essentially, World Series is done. Dodgers, Jays. There we go. It's already
Yeah, if we
set.
can only believe in what they've got for the odds.
Yeah, it'd be fun. It'd be fun, but certainly optimistic, right?
Yes.
Pretty much the pundits are almost in agreement here, at least the odds makers in agreement. Jays looking pretty strong at the start of the season, and they do think they have a very strong shot of being in the World Series here.
And again, I mean, the odds makers have to base it on everything that's gone on. And I mean, I know the Jays lost some of their players in the offseason, but they managed to make them up pretty well in the positions that were gone. So again, they're one of these teams that they have a young squad of big, great players, and they've just supplemented them going forward. So, I mean, it's another one of those ones of, I think we're all in for the next 2 or 3 years, just like the Dodgers have been in the last little while, just like the Astros have been. Usually the Yankees and the Red Sox are up there a little higher. But again, these are teams that, when you've got the opportunity, spend like you can and try to go for everything. It's become sort of the theme in sports nowadays is if you've got a great team, you're willing to spend it all. Because if you get that win 1 or 2 years in a row, then you're going to have to tear things apart based on salary caps and everything else and start over again. So capture what you can while you can. And yeah, I mean, looking at the Orioles there, I don't know that I'm very hopeful that they're going to get anywhere, but I'd be tempted with those kind of odds to put money down. What do you think?
That's a long shot of long shots. Yeah, 50,000 and plus 50,000 on the Orioles there. But that'd be a gambler's dream if that actually came through, right? That's a big payday. But Jay's looking good to start the season. That's phenomenal for Canada. We really only have one major baseball team, so it's nice when there can be a contender. But we'll get back to the markets here. We'll look at oil prices, kind of same theme. We talked about the yield curve inversion, talked about inflation, commodities, definitely part of that story. Oil, obviously a big factor there. And this is just a short-term chart of oil prices. It's really just half of 2021 into 2022. You can see oil prices in that $30 range, and then not too long afterwards, $130. So it was a pretty steep curve there, the jump. And then it's petered off a little bit recently. Now we're in the $100 zone. But that kind of run up, Kevin, where do you think the next leg is for oil? Are we going to consolidate for a while, or do you think there could be another leg higher?
Well, I think that the consolidation's there. I mean, if we take a look at it, sort of that end of 2020 into 2021 season, we started to see things on. You still had that COVID present, and then all of a sudden in November, straight through to the beginning of the year, things started to ease a bit. So now all of a sudden supply needs to come on. There's more demand for it. Then it levels off again for a while. Then as the start of 2022 again, less restrictions, more demand going on. But again, the recent spike has all been based on the Russia-Ukraine war and the amount of oil that Russia has. So I think that, as this goes on, it's probably going to play in that, anywhere between 90 and 110 range. So if things get worse, maybe it continues that way. But if it solves itself up, you're probably going to get a bit of a drop from where it is, just those sort of scenarios. So I wouldn't be betting on $130 or $140 oil tomorrow. And again, with all the environmental needs that we want to look at going forward, that's another factor to take a look at. How much more oil are we going to need and what kind of pricing strategy is going to go for there? So it's a bit of a mixed bag, but I would say that more consolidation in the next little while than I would a ramp up or a ramp down, of course, pending the war.
Yeah, that would be a big factor specific for oil. I think commodities in general, however, still have a lot of relative strength. Still seeing quite the trend in commodities. Definitely, if you look at the first quarter of 2022, that was really the only thing that made money were the commodities in the first couple of months of the year. And those kind of trends tend not to just end overnight. They tend not to be flashes in the pan. They tend to be longer lasting. So you could just see a consolidation for sure. Doesn't mean the overall uptrend is over. So I think commodities or higher commodity prices will probably be a factor for a while yet. But moving on here, we'll talk again related, talking travel. Obviously, need some energy to get those planes moving. And this is just a quick clip I found. It's from the Greek City Times, the massive boom they've seen in Europe, specifically in Greece in this particular snapshot. But I think it's a good representation, likely across the world. COVID slowly easing, restrictions coming off. People want to get out. People are traveling. No longer at home buying stuff online. Now we're out doing stuff. And my wife actually did some travel. She recently came back from Toronto. She said the Pearson Airport absolutely packed. So that's just an anecdotal story, but clearly mimics what's happening here with this headline. What are your thoughts here, Kevin? Are people going to be bursting at the seams to go out there and travel?
Yeah, I think it's coming to that. After 2 years of being able to basically only buy stuff Now you're right. People want to travel. They want to get back to that sort of scenario. I know a variety of people that they have this plan, they have that trip planned. There's cruises going on and everything else. So I don't see this slowing down anytime soon, especially if we're finding that the virus and the variants that are coming out are less deadly going forward. I think people are willing to do that. You're seeing less restrictions, less testing that has to go on between one place to another. I think that you're just going to continue to see this peak up, especially as you move into the summer season. I mean, driving is always a good one to deal with, but if you can fly and do some of those odds and ends, I think that the airlines are going to make a pretty good dent in what's going on, just because we've all been stuck in that situation for a while, and we'd all like to see something a little different, I think.
Yeah, and this going into this year, this was kind of the economic theory, right? That when we go from the buying stuff to the doing stuff, you'd see a shift to services as the economy reopens. That could be fuel for some economic growth. Of course, things always change and never unfold exactly as you thought. You throw some very high inflation in there, Russian commodities, or Russia, Ukraine, of course. A different scenario now than what perhaps people thought at the beginning of the year. But that was really the whole concept, was that shift to the services as the restrictions came off. Travel, absolutely a big part of that. I still think we're going to see it. I'm not sure how long lasting it will be, though. Is it going to be a massive travel for the next couple of years, or is this just initial boom that kind of normalizes? I have a feeling it'll be that option where you see initial boom and then it kind of normalizes to like a regular pattern for travel. But obviously people cooped up for a while. You're going to see that initial push when it comes to the services. And we always love your questions. We get lots of them every week. And one we've been getting a lot recently, and it's understandable. There's been definitely some market turbulence. And I'll tee it up for you here, Kevin. Market turbulence, how long is the market turbulence going to last?
Well, I'm going to say anywhere between 1 day and 3 years. That way I cover myself in all options. The hardest thing to predict is probably market turbulence. Again, just when things seem to be going in a straight way, you get something along the lines of the Russia-Ukraine war that comes out. The next thing you know, inflation numbers, if they go over 8%, that could have a dent on it. You could have something else come out of the sky. But based on where things are at the moment, I would say that just factor in what we did in 2021, where there was very little market turbulence whatsoever. I think you're going to get a little bit more through this year going forward. You do have to worry about what the 2 and 10 year curve did, the possibility of recession coming up. It does cause people to give a little bit of a panic or taking money out of the system. If the governments continue to fly by and continue to put money into it, that's sort of counterintuitive to some of the other methods. So I think you're going to get a little bit at least till summer. Summer, if we get that travel scenario and everything else, there may be a little bit more of a less volume pullback scenario and a little more smooth ride going into fall. But again, earnings numbers, everything else, I would say we probably got a little longer of this left, but I would not say that it's going to go straight through to the end of the year. What's your view?
Yeah, I mean, longer term, markets tend to go up more than they go down. So longer term, I'm not worried about what's happening right now. Shorter term, I think April seems to be like a relief rally. I think there's pretty good odds you get a nice bump in the month of April. Beyond that, you could see a little more turbulence. I think the year, though, however, I don't think this is going to be another banner year like we had last year, right? We actually had a couple in a row, 19, 20, 21, all ended up being pretty strong. I don't think that'll be the case this year. I think it's going to be more turbulent. It already has. I think lower expectations in terms of overall performance is probably in order when you look at 2022 as a whole. We've covered lots of ground there. You can see all our colorful X's and all the different topics. I think that means we're nearing the end here, Kevin. But we want to know if you have a question, you got to come find us. You got to go to chatwithclintonkevin.com. We'd love to hear from you. You can fill in the form, whatever the question is, whether it's financial or whether it's on a different topic. We always welcome people reaching out and contacting us. Anything you want to add, Kevin?
No, I'm speechless. Well, actually, I'm not, but I'm going to leave it at that anyways. So that's another episode of Back and Forth, and we will join us for the next one that's coming up very soon.
Take care.